Good morning. My favorite subject, paying taxes. No, wait a minute, not paying taxes. So today we're going to talk about tax strategies. We're going to have a little fun with this topic today. But if you think about it, if you make a lot of money and you're doing well in life, about 30 to 50% of what you earn goes to taxes, especially if you live in some of those high income tax states, California, New York, et cetera. So if you think about this, if you have debt, revolving debt, that's going to have an impact, maybe another third. So you're left with about a third of your money for basically your living expenses and to save money for retirement and do other, fun things with it. So what we're going to talk about today are some strategies that people can use in order to minimize taxes. So as we say here, there is no easy fix for putting more spendable income in your pocket. It's going to take a strategy to do it. For most medical professions, it's implementing a tax planning strategy that lowers or even eliminates your taxes. So what we want to talk about today is how to lower your taxable income, reduce your overall tax rate, and take advantage of utilizing some of the deductions and credits that are available. Now, our certified financial planners are all fiduciaries, and they work, as the introduction said, with many physicians. And much to my surprise, I heard recently that about 90% of them are only taking the standard deductions and not itemizing and taking advantage of a lot of things. In fact, we have a great little case study with a client that had a major tax bill. The IRS was on her back. There were penalties being assessed. And we worked with one of our subject matter experts who took a look at the last 3 years of her tax returns. They went back, looked at deductions she didn't take. This subject matter expert worked with the IRS, actually went back to the IRS and relieved about a $65,000 tax bill that she had because she wasn't taking advantage of the things she should have been taking advantage of. So when you work with most CPA firms, and I can tell you from personal experience, even with my own CPA, they're more looking in the rearview mirror and not looking through the windshield for opportunities. I mean, I talk to my CPA probably the first part of April every year, and he's gathering stuff, and he's telling me how much tax I have to pay. I go, what about doing this? What about doing that? And he goes, yeah, that's a good idea. I said, why aren't we doing this for 12 months? Why are we waiting to the last minute? And obviously, I always file an extension because we're rushing at the end of the year to try to get tax planning done. Because most CPAs, in their defense, from a compliance standpoint, it's a lot easier to have you just pay your taxes. Because then they don't have to get involved in audits, they don't have to get involved in kind of pushing the envelope with any strategies. So I find that most CPAs are more reactive and not proactive. So you need to be making smart year-round decisions rather than completing this at the end of the year. And a good example is, we all know about tax harvesting. So you have an investment portfolio, and at the end of the year, you look at all your gains, you look at all of your losses, and then you start to offset them to minimize your taxes. You should be doing that 12 months out of the year. If you have a great gain and a loss in January, you ought to be taking advantage of that. And you'll see the difference in your portfolio by just doing, tax harvesting throughout the year. So doing proper planning can significantly reduce your tax liability and obviously put more money in your pocket. So like putting together, choosing a good care program for a patient, having the right business structure could make a major difference in what you're doing. And if you think about how businesses are structured, from a sole proprietor, partnership, limited liability corporation, C Corp, S Corp, et cetera, having the right business structure plays a very important part in how much you can deduct. So I'm just going to talk about a couple of them, which are more prevalent for a physician practice. And that's the limited liability corporation, which many of you probably have, or an LLP. And I'm going to talk about the S Corp. So if you think about a limited liability corporation, its low filing cost and less paperwork is a major advantage. You got obviously limited liability that you have. You have more flexibility in how you're being taxed as a sole proprietor, as a partnership, as a corporation. And you can do this obviously as a one-person operation. So there's major advantages to doing that. The biggest difference is when you take a look at an S corporation. How many of you are S Corp? Yeah, so a number of you. The major advantage there, and we work with a lot of independent contractor emergency room physicians who are on contract with a major firm, and they're 1099, so they set up a sole corporation. They become an S Corp because they can take a look at their major income, take their deductions, and then they can pick a salary that they use, and the difference becomes a distribution, which saves on the self-employment tax, FICA tax, et cetera. So there's a major savings there. And if you work with a good tax advisor, they can determine what type of compensation you should be taking from your practice. So you're not only a physician, but you're running an organization. So if you break down the duties that you have, running the office and so forth, you come up with reasonable compensation in the IRS's terms. So when you think about how you can create more dollars in your pocket and reduce your taxes, you can do things like income shifting, putting your spouse on the payroll, putting your children on the payroll through your corporation. And there's a lot of case studies that do this. Think about 1099. You got an opportunity for more deductions than if you worked, say, for a hospital as a W-2 employee. You can do so much by having that entity in place. You can take a look at a sales leaseback. If you own equipment in your practice, you should own the equipment outside the practice and lease it back to the practice and picking up more deductions. And then think about timing of taking compensation. If you have a corporate structure, end of the year, you've got profits, you can actually roll some of those into the next year and so forth. And obviously, ordinary and necessary business expenses. And again, as an entity, you have a lot more opportunity to take those deductions. So I'm gonna have a little fun here with an example. We're gonna walk through navigating and understanding tax implications. So let's talk about how people save for retirement. How do we all save for retirement? I'm gonna use an example here of an individual who's, let's say, age 45, and I'm gonna call him Henry. He's a high earner, not rich yet, but we're gonna make him rich during this presentation. So where do you go when you're starting to save for retirement? What's the most logical place you go? And it's putting it into what I call a tax deferred bucket. That's your qualified plan. So you can set up a 401k plan. In 2024, you can put $23,000 away. And if you're over the age of 50, you can do $30,000. But if you're a sole operator in a sole organization, you can actually do a solo 401k with a profit sharing element to it, and you can put away about $69,000 a year. And again, over the age of 50, you can get up to $76,000 a year. So this is kind of the basics of where you start. Now, when you start to earn some money and you want to put more money away, you can put together something called the cash balance pension plan or a defined benefit plan. How many people have cash balance plans or defined benefit plans? A couple of you. So this is a real opportunity. If you have a practice and you have employees and you're providing a 401k plan, when the actuary does the calculation, a lot of their contribution is really coming from the 401k. So you're already funding part of this cash balance plan on your employees. And you can do up to about $480,000 a year. It all depends on your age, your income level, and the time horizon to retirement, but tremendous vehicle for sheltering additional dollars that become tax deductible and growing your retirement nest egg. So what happens after that? After you fill those first couple buckets of tax deferral, a major intervention happens here called the IRS. So before you do anything else, the IRS is coming in. Now, Chris Rock, before he was slapped by Will Smith, came out with a quote. He said, "You don't pay taxes, they take taxes." And if you put the IRS together, what does it spell? Theirs. So they're there basically to take your taxes before you can do anything else in the wealth accumulation. So the next logical thing Henry does here is he goes to a much bigger bucket that we call the taxable bucket. So this might be working with one of your financial advisors, whoever that may be, and they're going to put money into stocks, bonds, real estate, and a whole host of other. But you're doing it with after-tax dollars going into this bucket. So this bucket is much larger because we have a lot more investment options available, and we have no government limits on what you can do because you've already paid your tax on the front end. But you notice on the bottom here, this little aggravating little spigot called taxes. So when you end up selling assets from this bucket, you're going to pay capital gains or ordinary income. And if you have things like mutual funds in this bucket, you're going to have to pay tax on what they call realized gains. So you own a mutual fund, you never sold it, but Fidelity, Vanguard, or whoever sends you a statement at the end of the year saying you owe taxes. That's because they're turning over the portfolio. So you can do a lot with this bucket, but you really need to manage this bucket. So going back to tax harvesting, you need to do that throughout the year, not waiting till the end of the year. So you need to work with somebody who's actually going to take you through that. So as we go on in Henry's life, another advisor comes along and says, you ought to consider putting money into an annuity. Annuity is another tax-deferred concept, albeit you're putting after-tax dollars in, but they're growing tax-deferred to be paid out in the future. Now, annuities you have to be very careful with because you have to look at the load structure, the guarantees, and they're quite complicated. If you ever look at an annuity, I would have a third-party advisor look at it, someone who's not selling it to you. Obviously, the pros and cons. One of the reasons I put together my financial coach after many years working with financial advisors, I could never understand my financial advisor who was a CPA, a tax lawyer, and a CFP, but I wasn't sure if he was working on his retirement plan or mine. Because every time he made a recommendation, I would go, how do I know if that's the right thing to do? So at my financial coach, we have an unbiased and unconflicted service, meaning we don't sell any products or services. So when we talk to you about your planning and so forth, it's not, hey, you ought to put money into this stock, you ought to do this, or you ought to do that, because we're not actually selling anything. And I think that's the problem with most advisors. So now what happens in this wealth accumulation stage, if you think about this, you have two phases. The accumulation phase, everything that you own above the line, and everything you own below the line. So it doesn't matter what you're worth above the line, it really matters what you're worth below the line. So a lot of our clients come to us, and we've got a great technology platform for aggregating all of your assets and liabilities, and they go, what's my net worth? And we say, well, you have $2 million in your IRA plan, we're gonna give you credit for that on your net worth. But we know that it's not worth $2 million below the line because you're gonna have to pay taxes. So it's not really that valuable of an asset before tax, albeit we count it that way. So getting back to taxes, we've got federal taxes, we've got state taxes, we've got Social Security withholdings, we got Medicare, and there's lots of ways of managing those taxes. And then we have this thing called the SALT tax, state and local tax. And we all remember legislatively a few years ago that they capped the amount of deduction that you can take on your property tax. So if you have a property tax of $20,000, you can only tax deduct up to 10. However, some creative tax people have come up with ways that in those high tax states on property tax, you could actually deduct the entire 20,000. So there are tax strategies in doing that. But all of these taxes people start getting hit with. So it depends on where you live and how you pay your taxes. So if you live in the great state of California, as I once did until I moved for tax purposes, you're going to pay 13.3% is the highest income tax. But if you look down at Texas, or you look at the gray states, there's 8 of them in the country, there's no tax. So where you live when you retire is a major factor. So working with a number of people over the years, we had a client in California that actually put money into a retirement plan, and you get a deduction for not only federal, but also state. But a little known tax benefit that even many CPAs don't know about is called the source tax provision. So it says basically in a retirement plan, if you take your money out over a period of 10 years or longer, and you move to a state with no income tax or lower income tax, and you're a resident, you pay tax at that state. So I had a client once, he had about $5 million in his retirement account. He already elected to take it over a 15-year period. And he said, I'm moving to Lake Tahoe for retirement. Being a little facetious, I said, you're moving on the right-hand side of the lake, right? And he goes, no, actually, I'm moving on the California side. I go, why? Is the fishing better there? Or do you have family there? He goes, no, actually, the homes are cheaper on the California side of Lake Tahoe than the Nevada side. I go, there's a reason for that. Because if you move to the other side of the lake, the fact that you already have elected to take your money over a 15-year period, in his case, you pay no income tax on the distribution to California. It's in the federal tax code, and it can't be challenged by any state. So I remember one afternoon, he and his wife called me from the porch of the house, and they said, are you sure we're thinking about buying this house? And I said, get your CPA on the phone, I'll give him the tax code, but you can basically buy that house with the tax savings from California. So you think about where you live and the taxes that you're paying over and above the federal. When you're accumulating, you get the deduction, but where you live when you take the distribution is a major factor. Now, obviously, there's another tax that I talked about, which is the SALT tax, the property tax. So this chart ranks the number one is the best state. I think it's New Mexico, and the worst state being Connecticut, I believe. If you take a look at property taxes, it's very high. As an example, if you live in California, they're 14th, but if you live in Texas, it's 36. So my son lives in outside of Dallas, and he has a home, about $600,000 house, and he pays $18,000 a year for property tax. So if he lived in California for that same $600,000 house, if you could ever find one in California, he would pay about 40% of that amount in taxes. So where you live. So when you get into the retirement age, you need to look at the state provisions because many states freeze the property tax for retirees. So you need to look at the state and so forth. But where you live in retirement, not only from an income tax standpoint, but also from a property standpoint is very important. So I want to go back to the taxable bucket for a second. As I mentioned, when you pull money out of this, you're going to pay capital gains tax, and in some cases, you're going to pay ordinary income. If you go back to California, you're going to pay 20% plus 13.3 in capital gains, no offset. So that's why I vacated and moved over the line into Arizona at 4.5%, soon to be 2.5% on a flat tax. But there's also another tax. It's called the Affordable Cares Act. So if you accumulate investment income and you meet certain income thresholds, the government takes another 3.8% from your investment income. But if you have that money in qualified plan, like pension plans and so forth, there's no ACA tax on it. So thinking about how investments are taxed is real important. So if you think about getting an investment return of 10%, and after tax at 6%, look for something that you can get 6.5% on a tax-free basis, as an example. You gotta bring taxes in. So using my example of Henry, Henry's working with his advisor. He gets to the ripe old age of 55, and his advisors say, you know, Henry, you've done quite well in life, and maybe you ought to kick back a little bit and maybe start taking some of the income and all this accumulation that you have. But someone forgot to tell Henry about the age 59 and a half penalty, because he has most of his money sitting in a qualified pension plan or in that annuity, and the government says, if you take any money out of that before the age of 59 and a half, we're gonna hit you with a 10% penalty. So if that was his objective, he should have thought about accumulating money a little differently than what he's doing here. So then Henry and his spouse reach the age of 62 and they qualify for Social Security. And they're under the impression that Social Security is tax-free. But when they take a look at their adjusted gross income, Social Security is being taxed at 85%. 85% of what they're receiving. And then Henry and his spouse now hit the ripe old age of 65 and they qualify for Medicare. So they go to this website called Medicare.gov, and they find out that the more money they earn, the more the government takes on their Medicare. So this chart is today. And I see a lot of young people in the audience. Think about what this number is going to be 5, 10, 15 years in the future. So you got to manage that adjusted gross income and keep your income lower in retirement. So now we're sitting with Henry, and he's a little depressed, thinking, well, what else should I have been doing here about saving money? We said what you should have done and what you can do today if you're doing planning is to set up a tax advantage bucket. You need to diversify some of your holdings and come up with concepts that are actually gonna drop below the line, not affect your adjusted gross income, and be tax-free. So one of the areas that's often overlooked by a lot of people is a health savings account. So how many of you use a health savings account? So a number of you, that's good. Because you can do over $8,000 a year tax deductible going into the health savings account. Now that money grows tax deferred, can be used for medical expenses. You can carry it all the way until retirement. You can use it to offset your Part B and Part D. And if you want to take money out of that over and above that, it's like any other type of retirement plan. You pay tax on anything on the difference. And the government is currently looking at raising that amount that you can put into a health savings account. So it's not only good while you're working and offsetting current expenses, you can keep this thing going and bring it all the way into retirement. You also might want to think about Roth conversions early. So when you have up and down income years, you might want to think about taking some of those tax deferred buckets and converting some of that so that we can manage our adjusted gross income when we get to retirement. There's another strategy that a lot of people are using, and you see this with a lot of high net worth individuals. A lot of them were doing it offshore, and now there are products doing onshore. It's to use an insurance product. Now, we're not talking about whole life insurance or anything like that that you would buy for a death benefit. These are tax accumulation vehicles. So you go back to that bucket of taxable income, So you're in real estate, stocks, bonds, hedge funds, etc. You can actually put those inside a cellophane wrapper called life insurance, very thinly priced. And the advantage is it grows tax deferred like a Roth, and all the money comes out tax free with no limits on the amount. So a lot of people are using that strategy to accumulate dollars also. And sometimes they do it in concert. Now, we talked about the cash balance pension plan, and we talked about the defined benefit plan. But if you really think about these tax deferred programs, what we're doing is we're kicking the can down the road. Someday we're going to have to pay taxes. So in 2025, unless the current tax bill is renewed, taxes are going up. Federal taxes are going up. Corporate taxes are proposed to go up, and so forth. So if you have one of these cash balance pension plans, or if you have a defined benefit pension plan, there are strategies of putting an asset in there that can bring that balance out income tax free. So you tax deducted going in, and you can get it coming out the other side. Again, a tax strategy. Now at our booth, we have one of our subject matter experts here who can actually have the paper at the booth that can go into a little more detail on how that strategy works. But again, what you want to do is diversify and put more in your pocket. So there's a lot of opportunity here for people with appreciated assets. So if you have an appreciated asset, that could be your practice. You want to sell your practice sometime in the future, but you want to minimize your capital gains. So there are ways of either minimizing your capital gains or eliminating your capital gains. And we don't have the time to go into this today, but I took advantage of the first strategy when I sold the company to a New York Stock Exchange company. I took some of the proceeds, which is stock, I put it into a charitable remainder trust. I set up a family foundation to be the beneficiary, and my wife and I today enjoy a 7.3% distribution from that trust. But I saved taxes. I didn't pay any taxes on the capital gains. So there's a lot of strategies, like a charitable LLC, what Mark Zuckerberg did. It can be done at a lower level. So there's a lot of concepts out there. If you have an appreciated asset, selling your practice, or you bought Microsoft when it was low and you got a tremendous gain, how do you get out of it without paying that tax? So there's an opportunity to minimize or eliminate taxes. So in closing, what you want to do is diversify a tax strategy. We all have learned, in order to minimize risk in our portfolios, we want to diversify into different investment. You have to diversify how you receive your money in different buckets from a tax standpoint. Ordinary income, capital gains, tax-free. And you want to manage your income and taxation and retirement because it affects so many other things. And by stretching that out, minimizing your taxes, you can take care of that longevity risk and never really run out of money. So one final point on My Financial Coach. We're talking to a lot of people who say, I have a current advisor. But most advisors, like my advisors, have been good wealth managers, good insurance people, and so forth. And they do financial planning, albeit a little bit. And My Financial Coach, what we do is we have the full gamut of financial plan. So we don't manage money, we don't sell insurance, we know an awful lot about those subjects. We bring transparency to what you're doing, and we cover all aspects of financial planning, from estate planning, tax planning, and goal setting, retirement strategies, etc. Thank you all.